A fax machine. Not a hacker collective. Not an offshore syndicate with a decade of tradecraft. A single employee, a scanner, and a fax machine, and with that, they made $4 billion appear out of thin air, on the letterhead of one of the largest banks on earth. I've covered companies that hid fraud behind mark-to-market accounting, behind shell company mazes, behind software nobody could audit. Parmalat didn't need any of that. This one is almost insulting in how simple it was. And that's exactly why you need to hear it. Calisto Tanzi started this company in 1961, in Parma, Italy, selling milk. That's it. Milk. Over 4 decades he built it into one of the largest food companies on the planet, dozens of countries, tens of thousands of employees, a name Italians were genuinely proud of. By the early 2000s, Parmalat wasn't just a company. It was a national symbol, proof a family business from a small Italian city could go toe-to-toe with global conglomerates. Which makes what was happening underneath that success story so much worse. Because underneath it, for over a decade, none of it was fully real. Here's where it starts going wrong, and watch how ordinary this sounds at first. In the late 80s and through the 90s, Tanzi got ambitious. Tourism. A professional soccer team. Media ventures. All funded with debt, expanding in directions that had nothing to do with selling milk. Debt like that shows up somewhere. It has to. Normally, that's where the story ends, a company either manages the debt or it doesn't. Parmalat chose a third option. Instead of managing it, they made it disappear on paper, through a maze of offshore subsidiaries built specifically to turn real liabilities into fictional assets. And at the center of that maze sat one company you need to remember the name of, Bonlat Financing Corporation, incorporated in the Cayman Islands. Here's the part that doesn't add up, and I mean that almost literally, because once you hear this, you will not believe it held for as long as it did. Parmalat's auditors were told Bonlat held roughly $4 billion in cash. Real, spendable, sitting in an account cash. At Bank of America. In the Cayman Islands. That account did not exist. Investigators eventually traced the paper trail back to a single employee, working with nothing more sophisticated than a scanner, a photocopier, and a fax machine, who forged a bank confirmation letter on what looked exactly like genuine Bank of America letterhead. That's the entire mechanism. That's what $4 billion of fictional cash was resting on, for years, while some of the smartest people in international finance signed off on it. Someone was paid to catch this. I want to sit with that for a second, because it's the whole story in one sentence. Auditors are required to independently confirm major account balances. Call the bank yourself, don't just take the company's word for it. That's not advanced forensic accounting. That's page 1 of the manual. For years, that independent confirmation ran through channels Parmalat itself controlled. The company was, in effect, grading its own homework, and everyone downstream just accepted the grade. Then, in late 2003, under mounting outside pressure, somebody finally picked up the phone and called Bank of America directly, no intermediary, no company-controlled paperwork. The answer came back in days, the account doesn't exist. $4 billion, gone, because for over a decade nobody had made a 5-minute phone call. And here's where it gets worse, because $4 billion turned out to be the small number. Once investigators actually started pulling threads, Parmalat's real debt came in at roughly 14 billion euros. Not 4. 14. Built up across more than a decade, spread through dozens of offshore entities, each one a little harder to trace than the last. Tanzi and senior executives, including members of his own family, who held real positions inside the company, were accused of siphoning funds out for personal use on top of the accounting fraud itself. Some of that money propped up other Tanzi family businesses that were losing money on their own, including a struggling tourism venture. This was never just an accounting trick. This was a family treating a publicly traded, multinational food company like it was still the small dairy shop it started as in 1961. And here's the detail that, honestly, should have been the giveaway all along. Parmalat traded on Italy's stock exchange. It had shareholders, disclosure obligations, all the trappings of a serious multinational. But Tanzi and his relatives ran it, in practice, like nobody outside the family had a real say, subsidiaries and related companies operating well outside anything you'd call normal governance. Corporate governance experts now use Parmalat as the textbook case for exactly this failure mode, a founder who never actually let go, and a board that never actually pushed back. That's not a sophisticated fraud. That's just what happens when nobody in the room has the authority, or the nerve, to ask an obvious question. December 2003. The fake account gets exposed. Parmalat stock doesn't slide, it collapses, within days. The company defaults on bond payments it can no longer make. Within about 2 weeks, Parmalat files for bankruptcy under a specially fast-tracked Italian law. At the time, the largest corporate bankruptcy in European history. Calisto Tanzi is arrested within days of the collapse. Multiple separate Italian trials later, he's convicted on charges including fraudulent bankruptcy and criminal association, a combined sentence stacking up to somewhere around 17 to 18 years. A company that took over 40 years to build came apart in about 6 weeks. Roughly 135,000 ordinary Italian investors and bondholders lost money, people who bought Parmalat bonds because it was Parmalat. Safe. Trusted. A household name. A court-appointed administrator named Enrico Bondi took over what was left, sued the banks and auditors who'd enabled this for years, and did something genuinely rare in stories like this: he rebuilt it. Parmalat shed the unrelated businesses, restructured its debt, and relisted on the Milan Stock Exchange in 2005, eventually getting acquired by the French food giant Lactalis, still selling milk, decades later. The scandal became the reason Italy overhauled its corporate governance laws, specifically targeting the exact vulnerability that let this happen: founder-controlled companies with no independent board willing to ask an obvious question. Notice what didn't change the outcome here: complexity. Parmalat's fraud spanned dozens of offshore entities, sure, but the thing that finally broke it wasn't a team of forensic accountants untangling some brilliant web. It was one confirmation letter, checked properly, one time. Everything before that was just years of nobody bothering. I want to be straight with you about why this one bothers me more than some of the others I've covered. Wirecard had a genuinely elaborate fake business model behind it. Enron had accounting complexity so dense it took prosecutors years to fully map it. Parmalat had a fax machine. No brilliant scheme. No cutting-edge deception. Just a paper trail that nobody independently verified, for over a decade, until someone finally did, and it fell apart in an afternoon. And that's the thing I keep coming back to on this channel. Almost none of these frauds actually require genius. They require one basic check that somebody, somewhere, decided wasn't worth the phone call. Wirecard needed someone to independently verify Asian revenue. Madoff needed someone to actually run the math Markopoulos had already handed them. Parmalat needed someone to dial a number that was sitting right there in the file the whole time. The numbers always tell the story eventually. In Parmalat's case, the numbers were never even hiding that well. They were just waiting for one phone call nobody made. 14 billion euros stayed hidden behind a forged fax for over a decade. If that doesn't unsettle you a little, I don't think you were listening. Subscribe, there's always a next one, and it's rarely as clever as people assume.